as an investor, I raised the first pool of capital when I was 26. And I made an early investment in a company called Rockefeller Center Properties. And I saw management making a series of decisions that made no sense to me. And it was just so obvious the right thing to do as to how to create value. And it was being a frustrated passive investor that made me into an active investor. And that investment turned into a very profitable and very high profile investment. And with success, one is motivated to try it again. And it's been helpful to the strategy over a very long period of time. And it's fun. And if you're passive, you can feel like the market's patsy, and if you're active, you can actually create some value, and I think it's a lot more interesting.
Bill Ackman, the billionaire investor and hedge fund manager, is known for his bold moves and high-stakes bets. Ackman has consistently outperformed the market by thinking differently. But how did he turn a $400 million bet into a $2.6 billion profit? He has shared his surprising tactics that helped him crush the market by 30 times. In a recent interview, Bill Ackman laid out his investment process in a clear, straightforward way. Ackman's process is centered around a few key principles that I'll break down for you step by step. These principles have guided him through market ups and downs, and they can help you too. These 7 steps have made Ackman and his investors billions of dollars. The beauty of his approach? You don't need to be a Wall Street genius to start using these tactics yourself. Here are the steps. Step 1. Focus on quality over quantity. When it comes to investing, Ackman stresses that quality trumps quantity every time. Rather than spreading your money across dozens of stocks, Ackman believes in concentrating on a few companies that he knows deeply and believes in strongly. Here's what he says about it.
So, tell us a little about your portfolio. Why so few names? Obviously there has been some rumors of the performance up 6% for the first quarter. I know you can't say that's accurate or not accurate. With most of your portfolio up double digits, one down double digits, which we'll talk about. But give us just a take on why so few names and
So for a bunch of reasons. I mean, I've always had the view that, why not own the best 10 or 11 investments as opposed to ideas 12 through 25 or 12 through 100, which is more typical. And, I think there are very few great investments at any one time. So the ability to concentrate is an enormously valuable asset of a strategy. The problem with it is it leads to bumpier returns. And it leads to more attention on mistakes or things that aren't going well. I don't know a portfolio manager that doesn't have a stock that's down in his portfolio, right? But you don't read articles about, we're getting an awful lot of attention for a pretty high profile situation that's struggling. But I think there's, it depends on what your business model is. But if you want to make high rates of return over a long period of time, it's hard to do that being very diversified. I mean, if you look through the Forbes 400, wealthiest people in the world, most of them made their fortune in one business or a portfolio of 2 businesses. Very few made it in a portfolio of 100. So it's that, and the other benefit, it allows you to run a much simpler investment firm. We have an 8-person investment team. If we had 30 names, we couldn't manage that portfolio the way we do with a small team. By having a small team, you can hire better talent.
There's actually an argument that some people are now making that, buying the index or buying diversified funds have had much better returns than buying, those hedge funds that have, a very specific smaller portfolio approach, like yours.
I haven't seen that article. I mean, I think we've done very well relative to any index alternative, certainly. So it depends on how you judge us. I think if you judge us on a 90-day basis, I have no idea how we're going to do relative to an index. But I think this is a strategy that over time should earn a meaningful premium over, any kind of benchmark, or you shouldn't give us your money.
To understand this better, let's look at some numbers. According to a study by J.P. Morgan, over a 20-year period, nearly 40% of all stocks in the Russell 3000 index lost at least 70% of their value and never recovered. However, the top-performing 7% of stocks accounted for nearly all of the market returns during that time. That means a small fraction of companies are responsible for the majority of wealth creation in the stock market. Ackman's approach is all about finding these top-performing companies and investing in them with conviction. By focusing on a handful of high-quality stocks, He's able to understand his investments inside and out, allowing him to hold on to them even when the market is volatile. This strategy has been proven to work time and time again. For example, his main current investment vehicle, the London and Euronext listed Pershing Square Holdings, has returned 28% annually over the past 5 years, against 15% for the S&P 500. Since its inception nearly 10 years ago, however, the fund is trailing the S&P 500 by about 4 percentage points annually. Let's understand this step number 1 with a more simple example. Imagine you're running a business. Would you rather own a handful of high-performing, well-run companies or spread yourself thin across hundreds of mediocre ones? By concentrating on a select few, you have the bandwidth to make informed decisions and monitor each investment closely. This is the essence of Ackman's philosophy. Focus on what truly matters and let go of the rest. To put it in another way, think of your investments as a sports team. Would you rather have a roster full of average players or a few star athletes who can lead you to victory? Ackman's strategy is about assembling a team of the best performers and sticking with them through thick and thin. Step number 2, leverage market discrepancies. One of Ackman's most successful tactics is identifying and capitalizing on market discrepancies. Those moments when the market misprices a stock, giving savvy investors a chance to buy undervalued assets. And in this clip, he explains how he defines a good business and how, as capitalization has devalued over time, investment has become more accessible to the average man.
The vast majority of the capital markets today, the public capital markets, the investors are passive. They're indexed, they're closet indexed, they're indexed plus an alpha strategy. And if you look at the shareholder list of major companies, it's BlackRock, it's Fidelity, it's Cap Research, it's Vanguard, and by charter, these institutions are passive. If you think about capitalism, 100 years ago, it was very different, right? You had Carnegie, you had J.P. Morgan, you had players who'd buy big stakes in businesses. They were control shareholders. There was an owner on the board of directors. So capitalism over time has democratized, which I think is great for accessibility to the average man in terms of investing in the market. So we look for very high quality businesses, what we describe as simple, predictable, free cash flow generative, dominant businesses, a business that Warren Buffett would describe as having a moat around it, right? If you believe that the value of anything financial is the present value of the cash you can take out of it over its life, well, you need to know how much cash is going to generate over its life. So business quality to us is the single most important criterion for determining what's interesting. Because if we can't predict the cash flows, we don't know what it's worth. If we don't know what it's worth, we can't invest. So we figure out what it's worth, figure out how good the business is, how predictable will this cash flows be from a railroad or a spirits company or a real estate company, a shopping mall business. And then we say, okay, well, where's it trading? And if there's a wide gap between price and value, you can buy it for 50 cents, it's worth $1.20, well, then we're going to take a hard look and try to understand why it trades at a deep discount. And once we understand the reasons, we decide, well, these things that we can solve. Or can we, in light of the situation, the circumstances, can we be influential in changing these levers that can cause this valuation discrepancy to narrow? And is this a business that, while we're causing the valuation discrepancy to narrow, we can also perhaps contribute to the valuation growing? If those things are true, we found something that looks quite interesting for us.
Let's take Ackman's investment in Wachovia during the 2008 financial crisis as an example.
Investment philosophy, does it take a week, a month, 3 months to do the research, a year? I mean, you have 10 names. How long?
It depends. I mean, one of the best investments we ever made took us 4 hours to do the work. It was during the financial crisis.
Which was that?
Wachovia Corporation.
Okay.
So I was on my BlackBerry eating breakfast at the Brooklyn Diner in front of my building, and there was a story went across the, I was just, Wall Street Journal headline, Reuters headline, excuse me, went across saying, that Citigroup to acquire the Wachovia banking subsidiaries for $2 in Citigroup stock. Stock was halted. And this was kind of an interesting transaction because they were buying the subsidiaries for Citigroup stock. I figured, this is interesting. What happens to the holding company? So I went back to the, kind of went upstairs to the office and cracked open the 10K, and another member of the team, Mick McGuire, he and I worked on it. And what was interesting is the 1,000-page 10K of Wachovia Corporation, I think 900 pages were on the banking subsidiary. There was fewer than 100 pages on the holding company. And By buying the banking subsidiary, Citi was leaving a holding company which had cash, in Wachovia Securities, A.G. Edwards. They had paid $6-7 billion for it 6 months before. Evergreen Asset Management, and they were taking a $27 billion loss on the sale of the subsidiary. And it also had a liability called non-cumulative perpetual preferred stock, which if you ever want to have a liability in your life, this is the single greatest liability to have. It's a form of equity where you never have to pay a dividend, and when you don't pay them, they don't accumulate. And the worst case is they get a couple directors on the board, and you say hi to them each meeting, and you have this very, I said, look, this could be our Berkshire Hathaway. And at the end of the day, we figured the asset, in 4 hours we determined the holding company was worth at least $11 to $14 cash, a tax refund that you could carry back the $27 billion loss, recover cash taxes that have been paid. So you have this cash vehicle. You own Wachovia Securities, which is a good wealth management business. Mm-hmm. You own A.G. Edwards, another interesting asset. These are businesses you know well. And the stock opened after it was halted at $1.84. So we said, look, it's worth 11 to 14, $1.84. We bought 42% of the volume for the next 4 days.
So at the time, Wachovia's stock price had plummeted due to fears of insolvency. But Ackman recognized that the company's underlying assets were worth far more than the market was pricing in. He moved quickly, investing $600 million, which eventually turned into a $1.6 billion profit. That's a 2.6 return on investment in a very short period. This is a perfect example of how Ackman leverages market discrepancies. He spots opportunities that others overlook and acts decisively. This tactic is rooted in the principle of intrinsic value, understanding what a company is truly worth, regardless of what the market says. A study by the CFA Institute shows that mispricings in the market often occur due to short-term events that cause irrational selling or buying. By staying focused on the long-term fundamentals of a business, Ackman positions himself to profit when the market eventually corrects itself. This approach requires patience and conviction, but the rewards can be substantial. To make this concept more relatable, imagine you're at a garage sale and you spot a rare, valuable item that the seller is practically giving away because they don't know its true worth. You buy it for pennies on the dollar and later sell it for a huge profit. That's exactly what Ackman does on a much larger scale in the stock market. Another great example of this tactic in action is Ackman's investment in Howard Hughes Corporation. During the early days of the COVID-19 pandemic, Howard Hughes' stock price was hammered due to fears about the real estate market, but Ackman saw beyond the panic. He recognized that the company's assets, including master planned communities and valuable land holdings, were being deeply undervalued. By purchasing shares at distressed prices, Ackman positioned himself for substantial gains as the market recovered. Step number 3, use economic downturns to your advantage. One of the most counterintuitive secrets to Ackman's success is his ability to see opportunity in economic downturns. Rather than fearing recessions, he looks for businesses that are well positioned to survive and thrive when the economy recovers.
We bought a stake in Chipotle at a time where the company was struggling a few years ago. We put a few directors on the board. We recruited a new CEO named Brian Nickel. It's completely turned around the company. The stock has almost tripled in the midst of a crisis. And it just tells you that that's a lot more fun and it's a lot more profitable, and it's, I would say, a lot more good for America than just simply being a passive stock picker.
During the COVID-19 pandemic, Ackman made headlines with his bold bet on Hilton Worldwide. When the pandemic hit, Hilton's stock price plummeted as travel ground to a halt. But Ackman saw this as a temporary issue rather than a long-term problem. He understood that Hilton, with its strong brand and asset-light business model, was well-positioned to bounce back once travel resumed. He bought in at a low price, and as of 2023, Hilton's stock price has more than doubled from its pandemic lows, delivering substantial returns to Ackman and his investors.
The value of a business, unless it's a highly levered, very economically sensitive company, is not particularly affected by the by the event of a recession, right? If you own the value of a stock, right, the value of an interest in a company is the present value of the cash that business generates over its life. And if it's a business that should exist forever, well, pick Hilton, for example, we can expect that in past history, there's been a recession every 7 or 8 years. let's assume the future is the same and there's a recession every 7 or 8 years going forward. It doesn't, that's kind of factored into the value of the enterprise. The only reason why a recession destroys value is if you have a company that is highly levered, and then if revenues decline, their cash flow goes negative and they can't support their debt and they go bankrupt, right? But if you own a very well capitalized business, I don't think a recession has a meaningful impact. It might affect that year's revenues and cash flow, but that's just one line item in a long spreadsheet of cash flows that you discount.
This tactic of buying during downturns isn't just about having a contrarian mindset. It's backed by research. A study by the National Bureau of Economic Research found that companies with strong fundamentals that were bought during recessions significantly outperformed those that bought during economic expansions. Specifically, the study showed that stocks purchased during recessions tend to outperform by an average of 5 to 7% annually over the following decade. Ackman's approach is like planting seeds during a storm. While others are running for cover, he's out there sowing, knowing that when the sun comes out again, he'll reap a bountiful harvest. This mindset requires a deep understanding of the businesses he invests in and the confidence to stick with them through turbulent times. To illustrate this further, think about the 2008 financial crisis. While many investors were selling off their assets in panic, Ackman was buying into companies like General Growth Properties, a real estate investment trust. At the time, GGP was on the brink of bankruptcy, but Ackman saw value in its high-quality assets. He invested heavily, and when the company successfully restructured, his investment multiplied many times over. Step number 4, strategic concentration and risk management.
And we're a very concentrated investor. We put a large amount of capital in each commitment. We want these to be things that we can predict with a high degree of confidence over a long period of time. And
concentrating your investments in a few stocks can lead to big rewards, but it also comes with risks. Ackman is fully aware of this and manages his risks carefully. A prime example of Ackman's strategic concentration is his investment in Chipotle. In 2016, Chipotle's stock price had taken a massive hit due to a food safety crisis. Most investors were scared off, but Ackman saw an opportunity. He believed that Chipotle's strong brand and loyal customer base would allow it to recover. Ackman invested heavily, and his bet paid off. By 2021, Chipotle's stock had more than quadrupled, delivering massive returns. However, Ackman doesn't just throw caution to the wind when he concentrates his investments. He carefully manages risk by choosing businesses with strong fundamentals and a low likelihood of permanent capital loss. According to research by the CFA Institute, concentrated portfolios can outperform more diversified ones if the investor has a deep understanding of the companies they invest in and manages risk effectively. To make it more relatable, think of it like betting big on a few strong hands in poker, rather than spreading your bets across every game. By concentrating on a few high-conviction investments and managing risk, Ackman maximizes his returns while minimizing potential losses. Step number 5, hedge when the timing is right. One of Ackman's more surprising tactics is his use of strategic hedges. Hedging is like buying insurance for your investments. When the unexpected happens, you're covered. Ackman famously used this tactic during the COVID-19 pandemic. In early 2020, as the virus began spreading globally, Ackman purchased $400 million in credit default swaps, essentially betting that the credit markets would deteriorate. When the markets tanked in March, Ackman's CDS position skyrocketed in value, generating a $2.8 billion profit, a nearly 100-time return on his initial investment.
so we've actually made a lot of money on our hedges. So we spend a small amount of capital on investments that have option-like payoffs, and many of them are actually options themselves, not inherently particularly complicated, but a bet on interest rates rising, for example. So a couple of those bets have led to large profits for us this year. We've invested a little under $400 million, and that's turned into about $2.8 billion system-wide. Some of that profit was unrealized last year, accrued into our results last year, and the bulk of it has been realized this year. And those have been some very successful hedges, and we're doing more of that. It's something we've done over a long period of time, opportunistically, and I would say inherent volatility, uncertainty of the world has made a number of those hedges, both good hedges and also interesting standalone investments. So anytime you can hedge the portfolio, so for example, we thought rates would rise a lot, and we hedged rates by buying so-called interest rate swaptions. It helped offset some of the mark-to-market losses we've suffered on the long side of the portfolio, but it's also, on a standalone basis, a good investment, and those are the best hedges, ones where you don't mind making a big profit on the hedge, even if your stocks go down, because we think the businesses we own will do fine and recover over time. And in fact, our companies have actually reported quite good results. And so what we've seen is more a reduction in the multiples people are paying for businesses, really no real impact on the underlying companies themselves, at least for our portfolio.
This wasn't just luck. Ackman had seen the early signs of a looming crisis and used hedging to protect his portfolio and capitalize on the downturn. Research from Harvard Business School has shown that hedging can significantly reduce portfolio volatility and protect against market downturns, making it a powerful tool in an investor's arsenal. To make it simple, think of hedging as taking out an insurance policy on your house. You hope you never have to use it, but if disaster strikes, you'll be glad to have it. Ackman's use of hedging allowed him to not only protect his portfolio during the pandemic, but also generate significant profits when others were suffering losses. Hedging isn't just for billionaires like Ackman. Even individual investors can use options or other financial instruments to protect their portfolios from downside risk. The key is knowing when and how to use these tools effectively. Step number 6. Choose investments that are long-term. Ackman is a firm believer in the power of long-term investing. He doesn't just buy stocks with the intention of flipping them for a quick profit. He holds onto them for years, allowing compounding to work its magic. One of the best examples of this is Ackman's investment in Canadian Pacific Railway. Ackman first invested in CP in 2011, recognizing that the company had significant growth potential. He didn't just hold the stock for a few months or even a few years. He held onto it for over a decade, during which time the stock price more than quadrupled. This long-term approach allowed Ackman to reap the full benefits of CP's growth. Research does support Ackman's approach. A study by the CFA Institute found that investors who hold onto their stocks for the long term tend to outperform those who frequently trade. Specifically, the study showed that long-term investors earned an average annual return of 9.9%, compared to just 4.6% for those who traded frequently. In the same vein, Ackman's investment in Lowe's Companies Incorporated is another legacy to his long-term approach. Ackman began building his position in Lowe's in 2018, believing that the home improvement retailer was undervalued and poised for growth. Over the next few years, as Lowe's executed its strategic initiatives and the housing market boomed, the stock price surged, delivering substantial returns to Ackman and his investors. Step number 7. Conduct deep research. He doesn't make investments based on hunches or tips. He dives deep into the financials, management teams, and industry dynamics before making a move. Ackman's investment in Netflix is a perfect example of this. In early 2022, Netflix's stock price plummeted due to concerns over subscriber growth. Most investors saw this as a red flag, but Ackman saw an opportunity. He had done his homework, studying Netflix's business model, growth potential, and competitive advantages. Confident in his analysis, Ackman invested $1.1 billion into Netflix shares. While this investment faced short-term volatility, Ackman's research-driven approach gave him the conviction to hold on to the stock, confident that the company's long-term prospects remain strong. This deep research is what separates Ackman from many other investors. He doesn't just rely on surface-level information. He digs deep to understand the true value of the businesses he invests in. Think of it like buying a house. You wouldn't want to just buy the first one you see without inspecting it, checking the neighborhood, and making sure that it's a good investment. Ackman applies the same principle to his investments, ensuring that he knows everything there is to know before making a move. This research-driven approach is supported by data. According to a study by McKinsey, companies with a thorough due diligence process are 35% more likely to achieve higher returns on investment. By conducting deep research, Ackman sets himself up for success by knowing exactly what he's getting into. If you want to learn how to best invest your money in the easiest way with limited risk, check out this video on ETFs.